Good afternoon, everyone. This is Matt Dimitrition of Telemus Capital Management. Thanks for joining us today for the fourth quarter financial market commentary. I'm going to kind of walk you through kind of what we're looking at or what we saw in the fourth quarter for both the economy and the markets, both equity and fixed income markets, and then kind of take you through our outlook for 2020 on those as well. Let's start with the U.S. I guess one other point before we get started. If there's any questions, feel free to raise your hand, enter it in the chat box, or just hold them for the end, and we'll answer them at that point in time. Let's start with the economy and what we saw in the fourth quarter. The fourth quarter, we really saw kind of a stabilization of economic conditions during the fourth quarter, and then right at the end of the quarter, some of the big key geopolitical issues that we were looking for resolution on, frankly, throughout 2019, we finally saw some significant progress in. Those being the USMCA deal that replaced NAFTA was signed and ratified by Congress. We saw a phase one trade agreement happen between the U.S. and China, and that should be signed by President Trump a week from today. And then in the UK, we saw a landslide conservative victory that hopefully should lead to a resolution and conclusion to Brexit. All that seemed to happen in a one-week period in the middle of December. So all that leads us is pretty constructive as we enter 2020. But as we kind of saw as we headed into the fourth quarter, what we really saw was kind of a softening in economic conditions, particularly in the summer. We saw not only in the U.S. but globally really a decline in manufacturing activity on a year-over-year basis. And to my point on stability, we really saw that those levels stabilize. So we didn't see growth in manufacturing activity, but we didn't see it getting worse anymore, which was at least a nice start to what we were looking for. What we really saw also was going on was a shift in central bank activity. So central banks throughout most of 2019 had shifted from a tightening campaign to more of an easing campaign. And during 2019, we actually saw the Fed cut interest rates 3 times, with the last one occurring in October. But at that point, we really saw a shift in posture. And the Fed kind of came out and said, we're done cutting rates for now. We really need to see a notable change in economic conditions to see further action, whether that be up or down in interest rates. And we saw similar commentary and similar outlooks out of the ECB and the Bank of Japan, although maybe they weren't as firm in that viewpoint. One of the things the Fed's looking at is we've listened to FOMC members speak and gone through the meeting minutes of the Fed meetings. As it relates to higher interest rates, the Fed is clearly focused on inflation. They're frustrated that the inflation remains stubbornly low. Well, their dual mandates, one piece of that is to maintain inflation and maintain it around a 2% level, and it's just been hard to maintain it at that 2% level. As we have on the chart here, shows if you look at the G4 economies, so the US, the Eurozone, Japan, and the UK, inflation has really been just kind of stuck and been hard to kind of be sustained above that 2% level. And so our view is while we saw rates come down significantly during 2019, as we look at the possibility of interest rates rising, I think we really need to see inflation not only at 2%, but be sustained above 2% for an extended period of time before we can really expect any movement among short-term interest rates to move higher. As we break down the U.S. economy, a key part of the U.S. economy is consumer spending. Consumer spending represents about 68% of the economic growth. And one of the key trends of 2019, and we saw evidence of this in the fourth quarter as well, was really strong consumer confidence and consumer spending. And this chart here that we have in the upper right-hand corner of this slide shows the U.S. consumer confidence going back the past 50 years. Consumer confidence right now, the levels of consumer confidence haven't been this high since the late 1990s. This is a real positive for that key component of the economy that generates 68% of our economic output. On the flip side, business investment has been soft. Business investment is probably going to be down around 4 or 5% for 2019. And as you can see in the chart in the lower right-hand corner, the business confidence index has really kind of rolled over throughout 2019. This chart came from the OECD. And so businesses just aren't spending on capital equipment. They're managing inventories very tightly. I think a key reason for that was just due to the uncertainty around some of the trade negotiations and what the eventual outcome would be. And companies are just a little hesitant to deploy a lot of capital when they don't know what the rules of the game may be once some resolution is made. And so that was kind of the conflicting challenges throughout 2019 is a really strong consumer, kind of soft business conditions, and particularly on the manufacturing side. If we focus a bit more on the consumer and what's driving some of that confidence, conditions are really ripe just to be a good environment for the consumer as a whole. We've seen employment rate now of around 3%, the lowest in 50 years. Wage growth is also accelerating pace, as you can see in the chart in the lower right or lower left-hand corner. Wage growth is now around 3%. And so that's been at an accelerating pace. It's harder to find good employees. You have to pay them a little bit more. And with unemployment rates as low as they are, it's a nice competition that's out there. On top of that, the personal savings rate is still good. So consumers are still saving money. Right, the chart in the top right-hand corner shows that. Personal savings rates around 8%. But what's also happening is we're seeing increased consumption. And this is the chart in the lower right-hand corner. This really was elevated in 2018 following the Tax Cut and Jobs Act, where consumers did get a little bit of a break and were spending a little bit more. But what's notable to us is that momentum continued into 2019. In fact, we have consumers spending at a rate of about 4%, while wage growth is about 3%. So they're spending a little bit more than they're actually receiving as an increase in their paychecks, which is notable. If you kind of add all this up on top of lower interest rates, so debt service costs, there was a wave of refinancing activity, that's beneficial to consumers, and healthy stock and bond markets that we had in 2019 doesn't hurt either. And so this all adds up to a very strong consumer and high levels of consumer confidence, and we think this bodes well as we go into 2020 with the consumer in such good position. So as we look ahead to 2020, I think we would expect these conditions to remain at this point in time. There's no signs that would change, particularly on the consumer side. And so we expect a strong consumer to remain. On top of that, we're hopeful that we see a little bit of ease on business conditions now that we at least have a phase one trade deal happening. That's the low-hanging fruit. Some of the real big issues, particularly around technology transfers and intellectual property rights, those are still to come, and that will be part of a phase two deal that's probably going to take some time to work through, but we hope we at least see maybe business conditions stabilize. I'd love to see maybe a 1 or 2 or 3% growth in business investment in 2020. I'd be remiss if I didn't at least comment on kind of what's happened at least in the past week or the past few days. This was kind of our outlook as we entered 2020. It still remains our outlook, but obviously the wild card that came in was what's occurred out of the Mideast and the airstrikes that killed General Soleimani. At this point in time, it's really hard to decipher whether this is just a flare-up, as tends to happen occasionally throughout the Mideast, or if this is the start of a wider escalation. And obviously, if it's start of a wider escalation, we would see maybe more risk-conscious behavior among investors. If this is just a one-time flare-up, those things tend to kind of die off. And following President Trump's comments today, we've seen a little bit of an easing in the market and less volatility. Oil prices have declined, and so some of the things that shot up following the attack seem to have rolled over a bit, at least in a very short period of time. As we kind of move on to the markets, the equity markets were very robust in the fourth quarter as well as 2019 as a whole. The S&P 500 gained 9.1% in the fourth quarter and was up 31.5% in 2019, a very robust year. And across all indexes, they were very strong years. In the fourth quarter, the S&P 500, if you look at it at a sector level, was really driven by technology and healthcare. Technology was very strong throughout 2019, as you can see, up 50% on the year and was strong throughout the year. Healthcare had actually been a bit of a laggard going into the fourth quarter, and its robust performance helped it come back a little bit more in the fourth quarter. What's also noteworthy for the fourth quarter is kind of a reversal among more defensive, lower volatility stocks. As you can see, utilities and REITs were the worst performing sectors in the fourth quarter within the S&P 500. They had been among the stronger performers through the first three quarters. In fact, lower volatility, more defensive-oriented stocks held up quite well, even with the strong market rally through the first three quarters. But in the fourth quarter, there was less appetite for those stocks, and they lagged the broader benchmarks. We'd be remiss if we didn't talk about valuations as well. And so as we look at equities, we want to be cognizant of what price we're paying for them, and are we getting an attractive risk return from them. This chart in the lower right-hand quarter, courtesy of JP Morgan Asset Management, charts the price to earnings ratio. This is actually a forward price to earnings ratio, so it looks at the next 4 quarters of expected earnings for all the companies in the S&P 500, and it looks at that ratio over the past 25 years. Over the past 25 years, that ratio has averaged 16.3 times. It's kind of interesting if you look at this chart, it rarely sits at 16.3. It's usually hits 16.3 either on the way up or the way down, but that's been the average. We also have a couple periods of extreme in there, both in the tech bubble of the late 90s and the financial crisis in 08 and 09. And so those also kind of are extreme events on this chart. But where we sit today is we sit with a PE ratio on the S&P of 18.8 times. So that is higher than average. That's higher than that average of 16.3 times. However, given that we've seen a decline in interest rates, it's not unreasonable for us to think that an 18.8 PE is out there in the market. In addition, this chart has kind of dotted lines above and below that 16.3 multiple average. And those lines really show you one plus or minus one standard deviation. And again, we would expect the market to be within that range 2/3 of the time. And so we remain within that range. So as we look at the equity market trading at an 18.2 or 18.8 times estimated earnings, we look at it and kind of say that's neither expensive nor cheap at this point in time. Going forward, I think our expectation is that we would not expect further multiple expansion from here, but would expect returns to largely come from earnings growth. Right now, the S&P 500 is forecast to grow roughly 7% in 2020. And that, we think, is a good proxy to kind of think about equity returns. If we take the equity market and dissect it a little bit further, over time, the market has started to get kind of bucketed into growth and value stocks. And this chart here on this page really looks at the valuations of growth and value stocks. In 2019, the Russell 1000 growth, which measures large cap growth stocks, outperformed the Russell 1000 value index by 10 percentage points or 1,000 basis points. A pretty extreme difference. But if you actually look back over the last 3 years, growth stocks have outperformed value stocks by an average annualized rate of 10% as well. So we've really seen over those last 3 years a big divergence between the performance of growth and value stocks. And this chart kind of highlights how now growth stocks are starting to be a little bit more outsized in their PE multiple relative to value stocks. So we're starting to see value stocks look more attractive on a valuation basis. And we really haven't seen this level of bifurcation almost since the late 90s tech bubble, although as you can see from this chart, it's not nearly as close as that level of bifurcation. And so we do see some opportunities longer term in value stocks. Growth stocks is also, it should be important to note, roughly 25% of the growth index is solely made up of the FANGs. So your Facebook, Alphabet, Netflix, Google, Apple, Amazon. If we look outside the U.S., the fourth quarter was a bit of a shift as emerging market stocks were actually the star. So emerging market stocks had been lagging both the U.S. and developed markets, but were up 11.8% in the fourth quarter. The MSCI EAFE, which looks at developed international stocks, was up 8.2% in the fourth quarter, so slightly lagging the U.S., but stands also behind emerging market stocks. In fixed income markets, it was a fairly benign quarter. We saw stable interest rates, although we did see a steepening of the yield curve. A steepening happens when we see long-term rates go up at a higher rate than short-term rates. So short-term rates were fairly stable. Long-term rates went up a little bit. And so what you actually saw was a steeper yield curve than we had in the summer when it actually briefly inverted as long-term rates were below that of short-term rates. But we also ended the year on December 1st at having the steepest yield curve of 2019. In fact, the yield curve hadn't been that steep since October of 2018. The other thing that's kind of occurred in the fixed income markets was credit spreads continued to tighten. Remember, a spread really looks at the yield I'm getting on a corporate bond relative to what I would be getting on a comparable treasury. So the interest rate on a 2-year corporate bond compared to a 2-year treasury bond. And that difference in yield continued to tighten. So you're not getting paid that much more yield to be in a corporate bond that has some risk relative to a treasury bond. And this is something we are conscious of and have noted in our clients' portfolios and tried to take note of how much we're getting paid for taking any incremental risks. The other element to comment on in the fixed income markets is negative yielding debt. We don't have that in the US, but internationally and globally, in the third quarter, there had been $18 trillion worth of negative yielding debt. That came in a bit in the fourth quarter as of 12/31, there was only $11.5 trillion of negative yielding debt out there. If we move to commodity markets, oil rallied very strong. A key driver of that was OPEC and Russia agreeing to cut 500,000 barrels a day of production. This led to a nice 12% rise in the WTI crude oil price. So oil and oil-related stocks had a nice rally in the fourth quarter. Gold continued to be a stalwart. Gold was up over 50% in 2019 and was up a healthy 21% in the fourth quarter. Gold is being used as kind of a risk proxy and a way for clients or investors that are a little bit worried about risk in this environment to own some gold and own some real asset exposure. Lastly, if we look at currencies, the dollar had been fairly strong throughout 2019 and softened in the fourth quarter. It was actually depreciated by 3%. Driver of this is what happened in the UK, and there was a little bit more confidence in the British pound. But just in general, the dollar did sell off 3%. So you look for the year, it was up slightly, but what we really saw in the fourth quarter was it selling off. It's important to also look at the dollar kind of over the long term. So the chart in the lower right corner looks at the dollar over the last 20 years. And so it's important to kind of see that the dollar remains high relative to the global basket of currencies. It's not as high as it was in the tech bubble, but it's as high as it's kind of been for the period coming out of the tech bubble. So the dollar is really strong. This impacts actually international investments. And so a weakening dollar would be good for any investments in whether that's international developed markets or emerging markets. Now, if we jump ahead and look at kind of our outlook for 2020, as we look at kind of the economy, like I said, we kind of going into 2020 with a little bit more of a constructed view after seeing some significant progress made on Brexit and trade negotiations, as well as some stabilization in some of the economic variables. We continue to see the consumer as healthy, and we hope some of the geopolitical resolutions lead to some improving in business confidence. Equity returns, as we look at it, again, we aren't expecting a whole lot of multiple expansion in the PE multiple of the market, so we really think returns are largely going to come from earnings growth, and that's currently expected to be around 7%. Similarly, in the bond market, we had a great year of interest rates decreasing. That benefits bond prices, and that benefited bond returns in 2019. As we looked at 2020, we think interest rates are range-bound, and they're probably at the lower end of that historic range. So we don't expect a whole lot of shifts in interest rates. That being said, interest rates are incredibly hard to predict, and we don't think we nor anyone else is perfectly accurate at that because conditions do change. But given what we currently see in the environment, then we wouldn't expect notable shifts in interest rates, and as such, we would expect returns to largely just come from interest income, which currently on the Barclays Aggregate Index, kind of the broad-based U.S. proxy, that's a 2.3% rate. In the bond market, it's also kind of important to look at kind of where returns are going to come from and have come from and are going to come from. It's important to note the amount of corporate debt that is out there. Even the Fed in some of their minutes is calling out there is an elevated amount of corporate debt out in the market. So we're cognizant of that. Just because there's a lot of debt out there doesn't mean it's all bad debt, but you have to be conscious of the fact that there are companies that maybe are a little more leveraged than they had been in past cycles. and that is noteworthy. In addition, just the composition of the bond market is shifting. Investment grade and high yield bonds is always something we pay attention to. That cutoff between investment grade and high yield bonds is a triple B rating. So anything rated above triple B is considered investment grade, below triple B is considered high yield. Well, within the investment grade market, half of it is now represented by triple B rated bonds. That's the lowest quality rating among investment grades. Still a good, highly rated bond, but it's close to being a high yield bond. This compares to if going into the financial crisis in 2007, 2008, only 20% of the investment grade market was actually rated triple B. So you actually have a shift going on of more corporate debt outstanding. In addition, those corporate borrowers have lower ratings on their debt than they might have in past cycles. And one more layer on top of that, going back to what I previously had commented on, the spreads associated with corporate bonds relative to treasuries are particularly tight. So you're not getting paid a whole lot of incremental interest to take on that incremental risk. And so we're very conscious of this. And so what we've really seen over 2019 is we've kind of shifted up in quality where we can, where it's made sense. We've taken an exposure to corporate bonds and added maybe a little more exposure around the edges to mortgages or treasuries, where we just didn't feel like we were adequately being compensated for risk. We still see opportunities in the corporate bond market, but we're conscious of where we're being paid, where clients are being paid to take on incremental risk. And lastly, if we look at alternative investments, an area that does get increased discussion, an area we think does add value and is important for diversified portfolios. If we look at key categories of alternative investments, real estate remains an attractive asset class. We started to see a little bit of slowness in the development of new real estate projects, but real estate fundamentals remain healthy, and the attractiveness of real estate is it does throw off a nice cash flow stream. The flip side to it is capitalization rates, and capitalization rates are used to value real estate projects. The lower the capitalization rate, the higher the valuation. And cap rates are now towards the low end of their historical range. And so as we look forward, it's hard for us to envision cap rates going a lot lower. And so we really think investors should expect more income, the returns from real estate to really come from income versus maybe what they've experienced in recent years with a combination of both income and price appreciation. That being said, that's more categorically. There's always real estate projects where you can get value-added investors that may reposition or repurpose the property and are able to increase rents and increase the value of the property that way. And we do see those opportunities existing. Looking elsewhere in private equity, it's an asset class we think does add value over time. However, the valuations that private equity transactions are being done at are 2 multiple points higher than historic averages. So we think private equity firms are paying a lot to do deals. On top of that, there's a lot of quote unquote dry powder in private equity, where private equity managers have a lot of committed capital that they can spend, and we think that is a sign that those valuation multiples could get bid up even higher. This likely would lead to a little bit lower returns over time. So we like private equity, and categorically we see it as a little expensive, and so therefore we see as maybe not the opportune time to add capital to that asset class. That being said, there's always opportunities for good managers to find good deals in the space. And lastly, hedge funds. Hedge funds had better performance in 2019 than they did in prior years, but in an environment where the S&P 500 is up 31.5%, it's hard for most hedge funds to keep up with that, as they don't always tend to have market-like risk exposures. We still see value to hedge funds over time, but the return expectations maybe are a little lower than they might have been some time ago. So that kind of concludes kind of our outlook on things. To kind of reiterate, fourth quarter in 2019 were positive environments for both the economy and the markets. As we head into 2020, we really have a constructive view on the economy, but caution investors to kind of temper return expectations. 2019 was a great year. Probably some of the future returns were pulled a little bit into 2019, and so 2020 is probably a year where we're getting more moderate returns. So with that, I guess I'll open it up if there's any questions.
So one question so far. Question is just kind of with all the noise that's been it's gone on the first week of the year, I guess. Do you think that kind of noise the market can continue to brush off, the noise such as the manufacturing data, Iran, other events such as that?
Yeah, it's a good question, and one I've been racking my brain over. I think at this point in time, the indications are until there's maybe signs that this is more than just a brief flare-up, I think the market will shrug it off. If there are signs that there may be additional confrontation to come, I think then we may see a shift in risk behavior. But right now, investors seem to be willing to take risk and are looking for concrete evidence that would change. To your other point, Matt, on the ISM data, it was clearly the ISM manufacturing data for the month of December was a little weaker than even we had expected. There is a lot of noise in December because inventory levels and adjusting of inventory levels and just getting decisions on new orders can be more challenging just due to the seasonality of the holiday season. And so I think we would be looking for a little bit, we'd want to see a couple more data points before we really started to overreact to that number.
That's all the questions we have. Want to thank Matt and thank everyone for joining, and we will have a recording up on the website later this week for anyone who wants to review it later. So thank you again.
Thanks.